Good morning, ladies and gentlemen. Welcome to the Czech National Bank's meeting with analysts. Today we will present the new macroeconomic forecast, which was prepared by economists from the Monetary Department. And after the presentation, we will open the floor to your questions and further discussion. Let me introduce our speakers. Today we are here with the Deputy Governor of the Czech National Bank, Evy Zamrazilové. The Monetary Department is represented by the Executive Director, Petr Král.
Hello to everyone.
And the Director of Macroeconomic Forecasting Division, Karel Musil.
Good morning.
Let's begin with the new macroeconomic forecast, which will be presented by Petr Král. The floor is yours.
Thank you for the floor. Good morning once again from my side, ladies and gentlemen. It is really my great pleasure to be here again to deliver a presentation on CNB's new quarterly macroeconomic forecast. My presentation will be structured such as follows. I would like first to remind you of some structural changes regarding long-term equilibrium variables in the Czech Republic. We introduced already back in summer forecast, and now we did so in a more structural way. After that, I will shortly introduce the assumptions based on which the new macroeconomic forecast was prepared. After that, I will provide you with an in-depth insight into the new macroeconomic forecast as such, outlining both a qualitative story and quantitative dimension of that. After that, I will shortly compare the new forecast with the previous one, and final part of my presentation will be dedicated to scenarios and discussion of the risk we prepared to facilitate the monetary policy decision-making of the board. As you well know, during summer forecast, we introduced some changes regarding long-term equilibrium variables in the Czech economy concerning potential output growth rate, equilibrium pace of koruna appreciation, related productivity gains, and medium-term sustainable wage growth in business sector. We actually cut down the estimated potential output growth rate from 3% to 2.5%, related productivity growth from 3 to 2.5 as well. Long-term koruna appreciation trend has been shifted somewhat to a more mild values from minus 1.5% to 1%. And as we still keep a 2% inflation target with the decline in productivity gains, we shifted downwards the sustainable nominal wage growth in business sector from 5 to 4.5%. During this autumn forecasting round, we introduced these changes in a structural way, directly affecting the steady-state parameterization of the core projection G3 plus model, which had effects not only on the forecast, but also on the interpretation of the initial state and filtration of the respective values, influencing the initial state and with some prospective effects on the forecast. And I will emphasize these effects, particularly when explaining forecast of several endogenous variables. Now let me go to the assumptions, exogenous, let's say, assumptions we used when preparing the new forecast. As for the external side, we have been facing the fact that the economies of our major trading partners, which is the euro area, are undergoing subdued economic developments, and Germany, as our major trading partner, just avoided technical recession. For the euro area as a whole, in effective terms, we expect that for this year the GDP growth will be 0.5% and will accelerate to around 1% during next year. This will be driven by recovery in Germany, which is now facing economic weakness caused by both cyclical and structural factors, but we expect that those problems will gradually disappear. Up to now, we have seen quite a significant decline in producer prices in the euro area, but this decline will be fading away as the energy component, which is making the most significant negative contribution, will gradually normalize and will come to zero. We expect that the euro area nominal interest rates will go down further. This is the story of the headline, 3-month Euribor. The decline in the shadow rate we use in our core model will be somewhat dampened by the expected continued reduction of the ECB's balance sheet size. But in this term, there is no change in the expected pace of this balance sheet reduction, and the wedge between shadow rate and the headline 3-month Euribor is the same as it was in the previous forecast. The crude oil price has been quite volatile over summer and early autumn, but the current market outlook still remains slightly falling. When we are discussing the foreign outlook for interest rates, we have introduced an expert judgment or expert shift from the typically traditionally used market outlook based on financial instruments, as we seen that those market outlooks have been volatile quite a lot over the last, let's say, 3-4 quarters, as the markets reacted quite sharply to incoming macroeconomic data in the atmosphere when the ECB was emphasizing its data-dependent approach. And this volatility of foreign interest rate market outlook has been causing significant changes in the domestic interest rate path in our previous forecast, which was quite ugly. That's why we made an expertise in this area, and we introduced this expert judgment or expert shift from the market outlook towards less pronounced decline in foreign nominal interest rates in the months and quarters to come. And you can see the effect of this expert judgment in this graph. We've taken on board the fact that the ECB is still emphasizing data-dependent approach and is relatively benign when it comes to the future outlook and future forward guidance. And in some cases, the market reaction to new data might be seen as relatively pessimistic or relatively less justified by the other indicators. The effect on shadow rates is not the expert judgment does not relate the shadow rate component. So that's why the wedge between 3M Euribor and shadow rate is not touched by this expert judgment. As for domestic fiscal policy, we expect that after this year's quite strong nominal government consumption growth, we can expect a slight deceleration over the next 2 years. This year's the expenditure growth has been promoted by extra expenditures regarding the floods we saw in early autumn this year. In the year as a whole, fiscal policy is still keeping its restrictive or contractionary stance, which is stemming primarily from the consolidation package, which was introduced as from the beginning of this year. And on the top of that, there was definitive termination of the previous energy support measures for both households and enterprises. As these effects disappear, we can expect broadly neutral fiscal policy stance in 2025 and 2026. Let me now turn your attention to the new macro forecast as such. Inflation has been hovering close to our 2% target since the beginning of this year, but it went up to 2.6% in September, which was primarily caused by the renewal of food price growth, which will accelerate further throughout the rest of this year and at the beginning of next year. That's why we expect that headline inflation will go up further and will be around the upper boundary of our tolerance band, around the target at the turn of the year. Headline inflation will then decelerate gradually and will be only slightly above the 2% inflation target at the monetary policy horizon. Monetary policy relevant inflation, which is headline inflation excluding primary effects of indirect tax changes, will be slightly below the headline inflation over the whole forecast horizon and will be tick above the 2% target at monetary policy horizon. The wedge between these two measures of inflation will be affected by further harmonization changes in excise duties on tobacco and on excise duties rise in alcohol items within the consumer basket. As for the picture standing behind this prospect for inflation is quite interesting. As I already mentioned, food price growth renewed and accelerated further, being primarily affected by some specific items, partly imported from abroad and partly produced in the local economy. And further acceleration in this segment will be the cause of the further increase in headline inflation around the turn of this year. We cannot exclude fully that inflation might go somewhat above 3% in December and in January next year. But this will be only temporarily a wave, and after that we expect further, again, deceleration of inflation. This will be driven primarily by the fact that regulated price growth, which was extremely high in 2023, quite high this year, being currently around 7%, will decelerate sharply as from January next year and will go close to 2%. And this will promote the decline in headline inflation. On the other hand, core inflation has been quite stable over the last couple of quarters, being still somewhat above 2%, but not far from that. And we expect that the core inflation segment will keep its contributions to the overall price growth in the future, with gradually increasing contribution of imputed rents. Fuel prices are now declining, and we expect that their decline will continue for almost next year. As for the factors standing behind the net inflation and especially core inflation, we can see that there is a continuous pressure from the cost side, as firms are facing still relatively rapidly growing nominal wages, which are only partly compensated by productivity gains. Simultaneously, we've seen some import price pressures stemming from both year-on-year depreciation of the currency, promoted further by increase in some specific components such as agricultural commodities. On the other hand, markups or profit margins that had contributed quite a lot to the previous wave of inflation have been declining for some time, and their decline is expected to continue throughout the rest of forecast horizon, and their contribution to inflation as such has turned from positive to negative, and is quite significantly negative, and will offset the pressure from the cost side. The pressure from the cost side as such will gradually decline as nominal wage growth will decelerate after some volatility caused by a further increase in minimum wage and some other one-off factors, and productivity gains, which had been so far relatively muted, will start curbing wage costs and unit costs, unit labor costs by a large amount compared to what they did until recently. And the resulting picture from the intermediate price pressures is that those should decline over the next couple of quarters, and this will be promoted also by the gradual decline in core import prices contributions, as you can see in the right upper chart. The Czech economy has undergone relatively a long period of subdued economic activity, which has its consequences regarding the domestic labor market. The tightness on the labor market has been declining over time, as measured by our standard LUCI index. The unemployment is still very low, still one of the lowest in the world, but it is on an upward trend, and this trend should continue and is continuing, as confirmed by the data released today by the Ministry of Labor. We expect that nominal wage growth, which is or has been one of the major contributors to the domestic cost pressures on firms, is on a downward trend as well, and this downward trend should continue. On the other hand, the public sector pay will increase the pace of its growth as from January next year, as the initially planned increase in wages and salaries in this sector, or initially planned for September, has been postponed to January next year, and after some legislative changes has been implemented regarding the cascade of guaranteed salaries. The continuous nominal wage and salaries growth is now confronted by lower inflation compared to previous years. That's why the real wage bill is growing and is making space for increase in real consumption of domestic households. Being driven by the recovery of household consumption, the GDP growth for this year is expected to reach 1%. Besides household consumption growth, also government consumption is making a positive contribution. On the other hand, inventories and net exports are making negative contributions. For next year, we expect further acceleration of household consumption and recovery in investment, both regarding private and public segments. That's why we expect as a whole that GDP growth will accelerate to 2.4% in 2025, and the same pace is expected for 2026. According to the data released by the Czech Statistical Office a few days ago, the flash estimate of GDP for the third quarter, these figures seeing 0.3% in quarter-on-quarter dynamics and 1.3% in year-on-year dynamics, were fully in line with the new forecast of the Czech National Bank. As I mentioned, household consumption is on a recovering. Recovering. Maybe the recovery is somewhat less pronounced than we had anticipated in the beginning of this year, but it is here, and it is driven by the renewal of real disposable income growth of household sector. Until recently, households were facing quite huge uncertainty regarding future economic developments, regarding their own monthly bills being attacked by high energy prices, and they were also facing the effects of tightened domestic monetary conditions in the real interest rate component. That's why the savings rate went up and was hovering close to record high levels for some for some period of time. But we expect that after these two effects have been evading, savings rate is expected to come down gradually towards long-term average. Household government consumption, as I already mentioned, will decelerate next year from the currently heightened figures that were promoted by the expenditures related to floods. As for investment, the picture is quite interesting here. Inventories have started to generate quite significantly negative contributions in the last 2 years after firms were able to complete their previously unfinished production and to export it, and simultaneously they were not forced anymore to build extra inventories, extra stockpiling regarding materials and subcomponents, as the functioning of the global value chains have returned to normal situation. That's why they started to decline their inventories changes, and in some period of time, level of inventories even went down. This is seen in this graph by significantly negative contributions of inventories. This trend is at its end, and for the future we expect a return to the normal behavior of firms regarding their stockpiling. Private investment have been negatively influenced by subdued foreign demand and tightened monetary conditions, and for both private and public sector also by some traditional irregularities regarding the phase of the previous EU programming period and phase-in of the new programming period. But after these effects will disappear, both private and public investment growth will accelerate. In the public investment segment, we can rely not only by the standard EU funds sources, but also on the sources from a national resilience and recovery plan. Our small, very open economy has been traditionally very sensitive to the global trade developments and the demand in the countries of our major trading partners. Export growth is expected to decline as foreign demand has still not recovered fully from the weakness, and as the previous positive period of completing unfinished production and let's say addressing the backlog of orders has disappeared, and the low demand from abroad is now having clear negative effect on export performance. But as we expect, as I mentioned in the beginning, that the German economy and other Euro area economies will recover, both export and import dynamics will increase. As the domestic demand component will increase, also the contribution of net export will switch from currently positive figures to slightly negative contributions over the next 2 years. The forecast of the exchange rate expects koruna to be at 25.3 to euro in the fourth quarter of this year. After that, we expect mild depreciation of the koruna to 25.6 over the next couple of quarters. This will be caused primarily due to only gradual improvement of currently still subdued productivity in the country and expected falling in the trade surplus, or falling of the positive current account of balance of payments. Simultaneously, there is the effect of slowed pace of real equilibrium appreciation of the koruna. And as in the previous several forecasts, we expect that the narrowing interest rate differential of koruna vis-à-vis the euro will also have depreciation, some depreciation potential regarding the koruna developments in the future. Consistent with the new macroeconomic forecast is continued decline in market nominal interest rates initially, followed by broad stability of rates as from mid of next year onwards. As I was describing when discussing the inflation picture, the still restrictive monetary policy stance is facing the fact that on the one hand there is continuous cost pressure on the firms, and on the other hand the still subdued demand and positive real interest rates are curbing demand and are causing profit margins and their gap going downwards and curbing overall inflation. This pattern will continue for some time, and that's why there is some scope for further normalizing of monetary conditions or decreasing the tightness of currently restrictive monetary policy forecasted by our core model. And simultaneously, the expected ECB's policy rates decline, despite this expert shift, is also creating some room for further domestic interest rate cuts. Let me now briefly compare the new forecast with the previous one. As you can see, we have shifted our inflation forecast upwards, mainly because of higher food price growth we have already observed, and we expect to be in place in month-on-month or quarter-on-quarter basis throughout the rest of this year. And besides that, there is a negative base effect from last year, but this is not affecting the comparison with the previous forecast, because we very well knew about this effect already during previous forecast rounds. As for the GDP outlook, we have downgraded our forecast for the rest of this year and for the beginning of next year, as the domestic households consumption growth, as I was mentioning, is recovering a little bit more slowly than we anticipated. The slower wage growth in the new forecast is reflecting this downward shift in expected GDP outlook, together with some relatively weak wage data we've observed recently. Koruna outlook is weaker due to both domestic and foreign factors. We have incorporated lower outlook for interest rates in the foreign economy and worse prospect of foreign demand, which has a traditional depreciation effect on domestic corona exchange rate via net foreign asset channel. The weaker corona in this forecast compared to the previous one is also affected by the structural incorporation of the new steady state parameters of new equilibrium levels into the forecasting model, as the filtration of the initial conditions and the previous economic developments have come out to a conclusion that exchange rate in the past was a bit stronger, a bit more overvalued compared to what we thought before, implying tighter monetary conditions in the past. And this is now creating some room for faster decline in domestic interest rates that are offsetting the previous restrictive effect on the exchange rate. And simultaneously, this has some effect on the exchange rate as such, which is also in the new forecast depreciating a bit more rapidly compared to the previous forecast. As for the decomposition of the interest rate forecast change, you can clearly see that the major contributions to downward revision come from initial state, which has been incorporating the lower than expected GDP and wage data for the second quarter of this year compared to what we thought in summer, and simultaneously the revised interpretation of the previous effects of Czech koruna on the economy, as I just described. The second most important factor is the negative contribution of foreign environment, which is mainly reflecting the lower outlook for the foreign nominal interest rate, despite the expert shift from the market outlook we did in this new forecast. Expert judgments are also making a negative contribution to this shift after we partially eliminated the previously imposed adjustment that in the summer forecast led to higher wage growth and more pronounced household consumption, and partial elimination of these previously positive judgments is now making a negative contribution within this chart. Let me now dedicate my final part of my presentation to further scenarios we prepared to facilitate the monetary policy discussion of the board. This scenario of a bit slower decline in a profit margin is taking into account the fact that, as we expect headline inflation to go up throughout the rest of this year, this might have some second round effects via inflation expectations or inflation persistence on the rest of consumer prices. Despite this acceleration as such will be driven by food price growth. That's why we, in this scenario, we let's say assume that the non-tradable component within core inflation will be affected by this heightened overall inflation, and we increase the annual the annualized quarter-on-quarter inflation in this segment in order to get by half of a percentage point higher headline inflation at the end of next year. So in this scenario, the profit margins that are curbing inflation pressures in the baseline scenario are not working such efficiently to be able to fully compensate the cost pressures, and that's why headline inflation and core inflation is above the baseline scenario, which is causing domestic monetary authority to react with the nominal interest rate by their more gradual decline compared to the baseline scenario. Despite that, nominal wage or consistently with that, nominal wage growth is somewhat higher compared to the baseline scenario. The anti-inflationary risk regarding possible deeper and longer economic weakness in Germany and in the euro area as such has been motivation for the other alternative scenario, which is a scenario of economic downturn in the euro area. In this scenario, we used our NIGEM model for taking on board both cyclical and structural sources of economic weakness in the euro area. That's why, besides the cyclical slowdown, demand side, negative inflation pressures, there are also stagflationary structural supply side effects offsetting partly the negative demand effects on inflation in the euro area. As a result of that, headline inflation is relatively mildly below the baseline scenario, whereas the GDP growth is significantly below the baseline, and the output gap is opened more to a negative territory, which is in this scenario causing foreign monetary authority to react by a steeper decline in nominal interest rates. We import as highly dependent economy and highly export-oriented economy, a lower economic activity from abroad, which is causing our domestic GDP going significantly below the baseline scenario. Simultaneously, the weaker demand and weaker net foreign asset side will cause koruna exchange rate to depreciate vis-a-vis the baseline scenario. The negative domestic and foreign demand situation in this scenario are causing CPI inflation in the domestic economy being somewhat below baseline, which is in this scenario cause of lower, much more pronounced decline in domestic nominal interest rates. Very final part of my presentation is dedicated to a brief overview of our new scoreboard of inflation risk and monetary policy threats. As you can see, there are still some long-term risks to inflation. Those are stemming primarily from property price developments as prices of housing are on an upward trend. On the other hand, financial condition index for the euro area continues to point to lower inflation risk almost exclusively. And there is also easing of domestic inflationary risk regarding Czech government deficit and Czech labor market indicators, as the domestic labor market has been declining its tightness, as I was explaining during the previous part of my presentation. This chart is just summarizing the developments on the housing and mortgage market, where we have seen some relatively solid recovery in both mortgage, new business of mortgages, and some price increases following the previous decline in prices. Having said that, I would like to thank you for your attention by now, and I'm passing the floor back to our spokesperson, Mrs. Vlčková.
Thank you, and thank you for the presentation. We will now open the floor to questions and discussion. So, first of all, please remember to activate the closest microphone and to briefly introduce yourself before you speak. And the first question goes to Mr. Haverland.
Good morning, ladies and gentlemen. David Haverland from ING. I've got 3 questions, but I believe they are closely related. So I see lower interest rates, slower real GDP growth, and higher inflation. I would call it an unlucky combination. So if you could interpret a bit more that, specifically in the following light, has maybe Europe imposed a self-inflicting harm on itself? And is maybe Europe going through a negative supply shock in terms of its producing less for higher prices? And then maybe the 2.5% potential growth for Czechia is still maybe too optimistic, as the productivity has barely moved in the region, but the world has moved on. My second question goes to inflation, and we basically see inflation above the inflation target for 2025 and a bit of 2026. So my question is maybe Czech National Bank accepting a bit higher structural inflation, as the inflation kind of is above the target for quite some time? And we've seen that, for example, core inflation between 2009 and 2019 averaged 0.7%. In the last 4 years, it averaged 6.5% and is about to remain above the target for more than a year. So we have had these plausible ideas of if inflation is below the target for some time, it would not cause harm. And we see the projection of inflation and core inflation well above target for more than a year. And the third question is, it's likely that inflation would cross the 3% threshold till the end of the year, and it's going to remain a bit elevated for quite some time in 2025. So can we this still call price stability? And what would have to happen if we would not call the developments as price stability anymore? Thank you very much.
Okay, I'll start, and Mrs. Vice Governor will continue. The shifts in the new forecast towards the more stagflationary kind of style are, I would say, dominantly related to the food price growth, which is something we could only very loosely relate to domestic macroeconomic environment. Simultaneously, it is clear that after we hit 2% inflation, when we were hitting 2% inflation target in February and in several further months during this year, we were surprised on the downside by the food price decline. And from this perspective, we were lucky that declining food prices are compensating still very high growth in regulated price segment and still above the target core inflation segment. Now, food prices started to grow, being driven by cocoa, chocolate, coffee, milk, butter, etc. Those are possibly some one-off shifts in relative prices rather than a sign of new pro-inflationary environment building here. That's why we expect that this will not influence in the baseline scenario the overall anti-inflationary or disinflationary situation in the Czech economy. Core inflation is still expected to be tick above 2%, and the core inflation forecast for this year is 2.5, for next year 2.5, and for 2026 2.2, and the changes from the previous summer forecast are negligible. That's why I would say we are still in a situation which could be defined as price stability. In some volatility of headline inflation is normal. That's why we have tolerance band around our 2% inflation target, and we are now moving from 2% via 2.6 to possibly 3%. But this is something I would say not causing any problems. And as you mentioned, we will be back on a downward trend in the months to come. Just to make the things crystal clear, the model has a reaction function, which is monetary policy reaction function, which is written using monetary policy relevant inflation, which is headline inflation excluding primary effects of indirect exchanges. And monetary policy relevant inflation is 2.3 in the fourth quarter of next year and 2.1 in the first quarter of 2026, which is monetary policy horizon. So we are just tick above inflation target when measuring by a monetary policy relevant inflation.
Yes, your first question was about the GDP potential. Well, we will see. We will see, because this is the first, I would say, this is the first change of these variables. So this doesn't mean it is the last one. Yes, your question is, it's a good question, and it's quite reasonable, yeah. We will see that's also about the second scenario, which is about the economic downturn in the Eurozone. Well, Europe has many problems, we all know, structural problems, and we are a part of Europe, so this, well, as I said, is a good question. Well, about the inflation. Yes, I agree with my colleague Peter that the food surprised us at in a positive way in the first quarter. Now they are striking back, and yes, I agree that that's just a couple of some items, but it also suggests another point, which is something that great inflation is still alive. And we have to be careful about that. And I think that in our declaration, and as Mr. Governor has mentioned yesterday, we will continue to be very cautious, to be very prudent. At the same time, we perceive some long-term nature of the pressures in the area of services. Yes, it's also in our statement. We are not alone as a country. I think this is in many European countries. It's some phenomenon, post-COVID phenomenon or something like that. We will be careful about that, because this is a part of core inflation and not the volatile part. Your question about inflation above 3% level, it's also legitimate, because yes, price stability, it's defined up to 3%. I think the bank board will decide according to the nature. If there is high probability that the factors standing behind 3% inflation will evaporate soon, that would be okay. And then maybe also some offsetting factors, because we were, from the beginning of the year, we were speaking about the prices of services as pro-inflationary factor, and 5% of growth of prices of services was offset by very positive development in other part of the consumer basket, especially the food prices. And of course, fuel prices. This is another point, that the fuel prices are also an item that can be subject to geopolitical shocks, etc. So we cannot rely forever on this point. So there are many questions, and I think that we are not downplaying those factors standing behind the expected increase of inflation above 3%. I think we can promise as a bank board that we really will correct that the inflation environment will stay in the area that it should be.
Thank you, Mr. Sobíšek. Next question.
Hello, Pavel Sobíšek from Unicredit Bank. I have a question about the interest rates forecast. If I compare this one with the previous one, there's a striking downward shift in 3 months PRIBOR forecast, which, as Petr Král was explaining, was due to many factors. But if I focus on a steady state from 2025 onwards, there's just one factor behind it, and that's expert judgment. So I would like colleagues from the monetary section to elaborate a bit what's behind that, what kind of discussions there were on the expert level about this. And then probably Mrs. Vice Governor, if she could tell whether there was a discussion about this on yesterday's banking board, and what's her personal view, whether this shift is okay. Thank you.
First of all, I would like to clarify that Ms. Zamrazilova cannot give you her personal view, because she can only represent what the general overview of the bank board was. So maybe Petr will start?
Maybe next week. Paul, maybe next week.
You're absolutely right that expert judgments or adjustments are a significant downward factor in the interest rate forecast change, as shown by the decomposition. And as I was trying to explain, and my colleague will give you more detail, those are not a new expert judgment, but the elimination of the previous ones, because during the previous 2 or 3 forecast rounds, we had an internal discussion whether the model is a bit more pessimistic or a bit more optimistic when compared to the sectoral experts regarding recovery of and continuous growth in wages, private consumption, and domestic productivity. And we did some expert adjustments to bring more close to each other the expert view and the model view. And now we are, as the views are, by the way, converging, we are now eliminating these expert judgments. But Karel will give you more insight into that.
Yeah. So indeed, as it was mentioned, there are 2 or possibly 3 areas that the judgments were used. The first one is the consumption of the households, that indeed we expect that the recovery in the consumption will take a bit longer time than it's expected by the model. It's indeed adjustment of the previous expert judgments that we have already implemented into the projection. The model just simply see the recovery in real income of the households, decline in interest rates, and the recovery of the consumption, given some historical average behavior is assumed to be faster, so we reduced that. Second area is related to the wage dynamics. Again, the wage dynamics is expertly reduced to be a bit lower than the model expects. So indeed, the story about the high wage growth is reduced. Still, the wage growth is above the equilibrium or long-run trend. But again, that's the adjustment of the previous experts' view. The third area that's related to the productivity in the economy, indeed, that's the judgment that is not reducing the interest rates, but pushing the interest rates a bit up, and it's related to the fact that given the recovery of the economy that is, let's say, gradual and indeed still relatively high demand for labor hoarding effect in the economy, the productivity is quite reduced and recovering only gradually, which is pushing or generating inflationary pressures in the economy and pushing interest rates up. But these first two factors are overweighting the effect of the worse productivity, and in total, the expert judgments are pushing the interest rate trajectory from the new projection to be lower than in the previous one.
Thank you. Anyone? Next question.
Sorry, can I ask Mrs. Vice Governor to give me an opinion of the banking board or information whether this was discussed yesterday?
Yes, it was. Yes, we discussed that, and of course we asked for reasons, as you did.
So there was a consensus that this is the right change.
Well, this is very similar to the question, or this is the answer, maybe only similar to the question of Mr. Haverland, because there is also some connection to the changes of setting of those variables, yeah, the steady states, etc. And of course, these expert judgments are subject to our questions always, and yes, we do discuss them. But every individual member of the board has his or her own opinion, and of course there is also the voting may be affected a little bit by that, but just a little bit, I would say. Because the main point is the development of the inflation. And the development of the inflation wasn't, I would say, wasn't under any doubts or anything like that, because all of us are perceiving what's going on and how does the inflationary pressures or anti-inflationary factors develop, and we are quite I would say there are not great differences between us. No?
Thank you, Mr. Schindel.
And this is the forecast of the staff. Well, this is the forecast of the staff. So we cannot say we are happy with that or we are unhappy with that. We can just react to it by voting for. That's they have the right to construct their forecast as they see it.
Thank you, Jaromír Šindel, Citibank. Thank you for the presentation. I have questions regarding this 3 months Euribor expert judgment, because this is a relatively big change in the approach. So if you can a little bit elaborate, how are you doing this judgment, whether this is just a subjective view, which I do not believe. Yeah, so how you simply came up that interest rates or 3 months Euribor should be by 70-50 basis higher. And what is actually the current role of this 3 months shadow, 3 months Euribor? Yeah, because you haven't changed it yet, so does it mean that shadow Euribor rate actually has no role in the model? And if we speak about interest rates, I will just conclude with the questions on this neutral rate, because you have done a lot of changes for the steady states, and there was still doubts, questions, whether are you going to revise the neutral policy rate? So my question is, this is the final let's say, decision, or there will be ongoing discussion about the neutral policy rates in the future, not in the bank board, but for the model purpose? Thank you.
Sorry, until recently we took at the face value the market outlook for foreign interest rates as it was, let's say, seen in the screens at a certain period, in certain point in time during the preparatory stage of each forecast, and after the big inflation wave and fight of foreign central bank against inflation, and after the subsequent start of the cutting cycle, we've seen very volatile market outlooks reacting to individual pieces of new information quite significantly. And we changed our attitude by averaging 10 working days when computing this market outlook. Despite that, volatility was still here and was causing extra volatility in our domestic interest rate forecast, because in our model, in a small open economy, the UIP channel is a very significant transmission channel, and the model reacts very, let's say, very significantly to any changes of foreign interest rate outlook. Simultaneously, we saw some discrepancies or some diverging views between markets and ECB representatives regarding the ongoing cutting cycle of the ECB. The markets are, let's say, emphasizing the anti-inflationary risk regarding economic activity, whereas some ECB's representatives are still fully engaged in the fight against the inflation, which is not over, not even in our economy, but also in the euro area, and they expect some increase in the HICP inflation in the euro area throughout the rest of this year. That's why there are diverging views, and we needed to adjust our procedures. That's why we introduced this expert judgment, which was based on expertise of our colleagues from my department. They gone through the communication of ECB's representatives. They went through various financial market indicators to come up with this proposal. We took it on board, and we did this expert shift from market outlook to the actual trajectory. This expert adjustment did not relate the shadow component. That's why the deviation of the shadow rate from the actual 3-month Euribor in this forecast is the same as it was as if it had been without any change. So this component was not influenced by this expert judgment. So you know the elasticity, which is very high, of domestic interest rates to foreign interest rate outlook. So if we took on board the red line, the financial market outlook, we would definitely end up with somewhat more pronounced decline in domestic interest rate in such a scenario, which was not discussed at all. And for the R-star, from my point of view, the discussion is still open. We will go through another rounds of discussion with the board in the coming future. So far, we completed the changes in the steady-state parameters of the model by incorporating them in a structural way via the table, or in line with the table I showed you at the very beginning of my presentation. We did not extend the summer changes to the R-star and to the policy neutral rate, but everything is still open, and we will be discussing all the relevant parameterization of the Czech economy with the board in the future as well.
Thank you. Unfortunately, we have time for only one last question, so Mr. Bureš.
Good morning, Jan Bureš, CSO BN Patria Finance. I would like to have additional question to R-star. Maybe what's the opinion on the board, if Evy Zamrazilové could comment briefly on that, if there is still the view that was commented that the R-star should be maybe slightly higher than previously estimated, if that is the case.
I think yes, but this is not, I would say, final. This process never ends because there are structural changes in the world economy, in global economy, in European economy, in our economy. So it depends. We cannot work with parameters that are from the 90s. Yeah, so we have to. First, elaborate our own research about that and know the research of people from abroad, because I think that the R-star is not just our domestic headache, because many countries are in different position. It's not a position in the cycle. That's a position of, let's say, further potential. That's that's a deep discussion. It's about the potential output, about productivity possibility. If all these variables are different because the output is more shifting towards the services with lower productivity, so that's a huge discussion, and we cannot just say, well, we feel it's not this figure. It will be better to reduce by half basis point. That's not possible. We need to work on this, and you too. You are also researchers, and I think you are well educated and traveling abroad. You have your banks and their research behind. So it's a question, it's a challenge for all of us to understand this, what's happening.
One more remark. We have our own in-house methods of estimation of R-star. We have been updating on a regular basis, and the debate of the board will be supported by our rigorous approaches in this regard.
So thank you. Thank you all for participation. Many thanks for our questions and discussions, and we look forward to seeing you again next year. Goodbye.